Hello, welcome to this video demonstrating how to reformat financial statements. In this video, I'm going to demonstrate how to reformat a company's financial statements. For our case this semester, I've chosen a company called Australian Vintage Limited. They're a wine producer based in Australia, and I've opened up two of their financial statements for us. Here I have the consolidated statement of profit or loss and other comprehensive income for the financial year ended 30th of June 2020, and over here, I've got the profit and loss statement for the year ended 2019. I'll refer to these financial statements to help build this Excel spreadsheet demonstration. So the first thing we need to do when we're reformatting our financial statements is access the data that we need. So I just showed you that I've loaded up the Australian Vintage Limited financial statements for 2019 and 2020. And previously, I also got the 2017 and 2018 financial statements as well to get information for those years. So first of all, I'm going to look at the balance sheet. And the first step here is a little bit time consuming and a little bit slow. But what I had to do is I've opened up the financial statements. I've gone to the balance sheet, or consolidated statement of financial position as they call it. And I've literally just entered in the information from this financial statement into my spreadsheet as a starting point. So here I've got the June 2019 cash and cash equivalents, 8,057. In 2019, I've entered the cash as 8,057. So the first step of the process is getting the data from the financial statements into Excel. Now there are some databases that can make this a little bit quicker for us in the future, but as it's your first time valuing a company, I want you to do it the manual way to start, because sometimes databases merge accounts together or they reclassify accounts in ways that may not be appropriate for what we want to do. So step one. I open up the financial statements and I enter in all the accounts for my balance sheet, and I enter in all the accounts also for my income statement. For example, 2019 here, I've got a total comprehensive income for the year of 8,426. When I go to my spreadsheet, I go to my income statement. For 2019, I've got a comprehensive income of 8,426. In this spreadsheet, I've used a few colors to sort of draw your attention to things. So for example, here I've flagged some cells in red, and I've put some little notes here. I've said the 2018 income statement was restated. I've used the numbers from the 2019 annual report. So when I'm entering the numbers for 2018 here, if I look at the 2018 annual report and I look at the 2019 annual report that uses 2018 figures as well, they're going to be different numbers. Now, this does happen quite often, that companies might make mistakes with their accounting and they have to restate the numbers. And it's always important to use the newer numbers. So for example, in this 2019 annual report, it says the 2018 figures here were restated. So these are the numbers that I'm using for 2018. So that's important. In case your company's had a restatement, you need to use the restated or more up-to-date, newer, more relevant information in your spreadsheet. Another thing to be aware of in the spreadsheet, here I've entered all these expenses as positive numbers, and I know what expenses are and I know how to treat them. I'm happy to keep all my numbers here as positive numbers. In the statement they've provided, they've put all their expenses in brackets indicating their negative numbers. So then when they've got other income as a positive, that means it was a revenue, not an expense. And I've done it the opposite way. That's just my preference there. Okay, so be consistent. If you want to use all positive numbers and you know expenses are minus from revenues, that's fine. Or if you want to call your expenses minuses and you'd say revenues plus a minus expense, just be consistent. Either way is perfectly fine, whatever your preference is. When you've finished entering in your balance sheet and income statement data, just make sure you double check that all the headings are the same and you haven't made any typos. So for example, comprehensive income here, I've actually done the calculation. I haven't just typed in the comprehensive income. I've done the calculation, net profit after tax, plus the other comprehensive income, and just make sure everything balances out. I've recalculated the profit, the revenues minus the expenses. Again, I just have these little checks to make sure I haven't made a data entry error. Okay, so let's get into reformatting now. We're going to reformat the balance sheet first. The balance sheet is the easier of the statements to reformat, and it's reasonably straightforward to do. So I've already prepared it for you, but I'm going to talk about how I prepared this reformatted balance sheet. So first of all, I want you to look at the headings on the reformatted balance sheet. I've got current operating assets and non-current operating assets. Then underneath that, I've got current operating liabilities and non-current operating liabilities. I then calculate a subheading, net operating assets. Underneath that, I have financing assets and financing liabilities, and I calculate a subheading, net financial obligations. And then I check everything works. Total equity is going to be equal to my net operating assets minus net financial obligations. And I check that the equity is the same as in the balance sheet before I reformatted. Okay, so to recap, when we reformat, we're splitting things into operating versus financing activities. Up the top here, I've listed all of the operating activities, and they can include both operating assets and operating liabilities. Then down the bottom here, I've looked at my financing activities, and I've got financing assets and financing liabilities to calculate my financial obligations. So the thing we need to do, we need to split up our accounts into operating versus financing activities. To decide if something is a financing activity, the rule is if there is interest associated with that account, we will classify it as a financing activity. So I look at my balance sheet and I go, okay, line by line, what is everything? I'll just classify them all. Cash, generally we're going to call cash an operating activity. You need it as part of your operations. But I will read the note to the financial statements and I'll see if they tell me if they've got any cash in term deposits or invested in accounts that will generate interest revenue. If there is that sort of breakdown, then I can split up cash maybe into some operating, some financing. But generally, I'm just going to leave it as an operating thing. Trade receivables. The majority of trade receivables will have no interest associated with it. It's when your customers owe you money, and we'll just call it operating. Inventory, same thing, no interest associated with inventory, so it's an operating activity. Then I get to something like other financial assets. And I'm going to have to look at the notes to the financial statements and figure out how to classify it. So when I go to my reformatted balance sheet over here, for other financial assets, it says for 2020, I am classifying as current financial assets 1,435 as operating as it relates to foreign currency contracts and hedging. It is part of their operations, not a way of financing. Okay, so I went into the financial statements, so the 2020 financial statement, and I see they've got an asset, other financial assets. Now, it's got the word financial in it, so I'm automatically thinking it's probably a financing activity. I look at note 15. When I find note 15 here, I see the current assets are derivative financial instruments, foreign currency forward contracts for the value of 1,435. Now, this business is selling their products internationally, so they're going to be using foreign currency. They've got derivative financial instruments for that foreign currency. I think that's going to be part of their operations. I don't think that's how they're financing the business. They're not borrowing money from a bank and having to pay interest, that kind of financing. This is a financial instrument. It is some sort of financing activity, but it's for their operations, in my opinion. So I'm going to call this as an operating. There's no interest associated with this contract that I know of. So I'm just going to call this part of the operations. So when I look at my current operating assets, I've listed other financial assets, this 1,435 as operating here. I then keep going down my balance sheet. Okay, I keep looking through all the accounts and classifying if there's interest or not. We get to other financial assets, the non-current assets. And again, I read note 15, and in this time, I've split up the number. So on the balance sheet, non-current other financial assets is 4,407. I look at the financial statement in note 15. They've got 4,407 non-current assets, which are financial assets. And I actually see here they've got investments held at fair value. Well, they're investments held at fair value. That's probably investments in other businesses, subsidiaries, that kind of thing. And I'm going to say that's part of their operations. Loan receivable, however, the word loan indicates we're probably going to be getting some interest paid on that. So I'm going to classify that as a financing asset. Prepaid borrowing costs, maybe we've paid some of our interest or fees in advance. So I'd say that's probably part of our financing. And then we've got the derivative financial instruments, which I'm going to say are probably more to do with the business's operations rather than how they finance things. So I'm going to classify some of the amount as, in my reformatted balance sheet, some of the financial assets I'm classifying as operating. Then if I go down to my financing assets, I've got 706, which is the 640 loan receivable plus the 66 prepaid borrowing cost. I think they're financing assets because there's interest associated with them. They're loans and there's borrowing costs. So those words are indicating to me that they're part of the financing. Okay, so what we've been doing is we've been going through each account and checking if there's interest associated with it. And so far, the only account that I think there's interest associated with it on the asset side is part of the other financial assets. We go through and do the same with the liabilities. Something like trade payables generally doesn't have interest associated with it. It's when you owe your suppliers money for the supplies that they've given you. But then we get an account like borrowings, and now there's no borrowings, current borrowings in 2020, but prior years there was borrowings. So I'm going to be calling that a financing activity. Lease liabilities. Leases are generally considered financing because it's similar to borrowing money from the bank to buy an asset. You pay interest on it. A lease is kind of all those steps rolled into one, where a leasing company will give you the asset, but you pay interest and lease fees to the... So I'm going to call lease liabilities a financing activity. So we go through all our liabilities and we have a look at our reformatted balance sheet here. The operating liabilities I've called trade payables, the provisions, income received in advance, all part of the operations. Then we go down to financing liabilities. I've said the borrowings, both current and non-current. Lease liabilities, both current and non-current, and some of the financial liabilities as well. Okay, so I've split out some of that. So now that I've gone through all my assets and liabilities and classified operating and financing, to calculate net operating assets, it is my current operating assets plus my non-current operating assets. So I get the total assets, total operating assets. Then I minus off the current operating liabilities and the non-current operating liabilities to get my net operating assets. So it's my operating assets minus my operating liabilities. Gives me net operating assets. Then in the financing section, I'm going to calculate what's called net financial obligations. Here are all my financing liabilities, both current and non-current. And then I minus off my financing assets to get how much I owe on my financing activities in total, my net financial obligations. And then I check the balance sheet still balances. NOA minus NFO gives me equity. Okay, so I've calculated it here. Then I just check that I've still got my balance sheet balancing. I'm referencing the balance sheet equity balance down here, 303,409, 303,409. So it's still balancing after I reformat. If you're finding your balance sheet after you reformatted, your total equity is a different amount to the unformatted balance sheet, it means you've made a mistake and you've probably just missed out one of the accounts somewhere as you're transferring accounts across. So that is the reformatted balance sheet.